Hi everybody, and welcome to our Friday Market Insights. This week, Wayne Wachell, founding partner, CIO and CEO of Genus, is joining us, and I am Grant Conroy, portfolio manager at Genus. So Wayne, jumping straight into it, it's a very strong week following a record November for many of the stock markets around the world. Can you tell us a little around what happened this week, and maybe at 22 times 2021 earnings on the S&P, where you think we go from here?
Sure. Well, it was a good week. More positive news on the vaccines coming down the pike, and on that news, bond rates backed up. We have a 10-year U.S. in the 90s now, so it's come a long ways, and that got sort of the risk-on thing happening. And we had value stocks doing better than growth stocks this week as well. So just more good news in place. If you look at the P based on 2021, it's around 21.5. On 2022, which is really post-pandemic, it's after the pandemic, right? So that's about 18.5, which isn't bad given the fact that we have these low interest rates, short-term rates close to zero. So from a discounted rate perspective, it's not bad. We're not bad value here. There's so many good things, in the pipeline in terms of Fed easing, more government spending, and vaccines on the way.
Great, and you mentioned the value trade there. I think the Dow had its biggest month, or its best ever November, the best ever for the Dow, so that's saying something. On the economic side of things, we had sort of some mixed economic data. The jobs today, a little bit better in Canada, a bit underwhelming in the US, but purchasing managers index around the world seem to, for the most part, still be holding up and doing very well in expansionary territory. Can you just explain to us a little bit why they're important as a lead indicator and what we're thinking for them going forwards?
Yes. The PMI is a corporate sentiment indicator, and it tends to lead the real economy by about 3 months, 2 to 3 months. So it's predictive of future stronger growth over the next 2-3 months in the world economy. As well, if you look at global money supply leads PMIs by 9 months. So global money supply leads the real economy by 12 months. And global money supply is just through the roof. So that means this time next year, or this time maybe in September of next year, PMI should be very strong and the economy should be very strong. And that's what market's banking on, is stronger growth. That's why we're seeing the value trade starting to move and the economic sensitive stocks moving as well.
That's great. Yeah, it all seems to feed into itself, I guess, in terms of the market. And on the pandemic front, it feels a little bit like the market's just moved beyond the COVID news now. We've had 3 weeks of vaccine announcements, and that's obviously helped. But the potential for a sort of post-US Thanksgiving surge, where obviously case numbers are high, and then I think it was the highest travel weekend since March, and the combination of Pfizer talking about logistical issues in rolling out the vaccine. Could it be the market's dismissed the COVID concerns a bit too early?
I don't think so. I think, the pandemic is coming back hard here, and it's going to be worse than last spring. But the economies of the world have adapted dramatically to where they were last spring. Things are getting delivered now. The economy's moving on, except for certain areas like the restaurants and cruise ships and airlines, for example. But there's been a big adaptation. And then we're looking at, I would say, the numbers right now are probably about 20% herd immunity. And probably we'll get to 50-60% herd immunity, which is really enough to really clamp this thing down, probably sometime in June of this year. And if, I would say if the deliveries actually improve, maybe the end of March, April. But I'm saying at least the end of June, we should have herd immunity. And that's what the market is looking at. It's looking at 6 to 9 months in advance. That's what it does. And there's going to be some bumpy weather ahead, but it sees sunshine beyond that. And I think that's what it's focusing on longer term. And I think if you, as an investor, play too much, focusing on the stormy weather here, you'll miss the opportunities when the sun comes out next June.
Sure. So if there were a pullback, it might be an opportunity possibly as well.
And I think the thing here is to play the economic sensitive areas and the areas that will do well as the economy opens up.
Great. Moving on to the stock front, Tesla, or the S&P 500 announced that Tesla will be added into the index on December the 18th. The stock's up around 600% this year, and it's going to be a whopping $72 billion addition to the S&P 500. It's the biggest ever index add. I guess, can you explain some of the repercussions around that being added to the index? And do we own Tesla for some of our
Well, no,
clients?
we do own Tesla. It's in our high impact fund. It's very impactful, obviously. 100% of its revenues, that's how we look at things, are really focused on efficiency and the electronic vehicle, obviously. So it's very impactful the way we look at the world. And so we have a big weighting in our impact portfolio. If you look at the breakdown of active investors versus passive investors or index funds, it's probably about 50-50 right now. And so that means there's going to be a big appetite a lot of the passive investors, index funds, have to hold Tesla in their portfolios. So whenever there's flows coming into the marketplace, half of them are going to have some exposure to Tesla. So that's the good news for Tesla longer term. We can have discussions about valuation, but there's going to be buying power from the passive investors going forward for some time.
I guess it's always tricky for the passive funds and for the ETFs when it's announced that they've got to buy $72 billion of a stock on a fixed date at a fixed time. The whole world knows how to make some money in terms of buying it ahead of that fixed date and fixed time. Yeah. So it's a bit of a catch-22 for them.
Exactly.
Well, great. I think that just about wraps it up. And it seems that the economy is still on track. There might be some near-term chop in the markets with possibly some COVID news, but the longer-term outlook and the lead indicators all still remain positive. So long may it continue.
Amen.
Thank you very much and have a good weekend.
Thanks, Conroy.